Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and of course, a little bit of crystal ball gazing. Today is Wednesday, January 15th, 2025. Today's episode, we're going to talk about CPI coming in cooler than expected, the Consumer Price Index, the prices that people pay when they're paying for goods and services. Last expected and actual, the Consumer Price Index, actually month over month, according to marketwatch.com. By the way, I do see conflicting reports out there as how these numbers are actually. I think some of them might just round it down no matter what. It doesn't matter that much, but came out higher than expected, but year over year came out on point. The one that really got the 10-year note yield to drop was the core CPI, seeing as though, energy and food has been, it's more volatile and it's colder. And so energy, has some tailwinds to send the price going higher, plus the things going on with Russia right now. And so, excluding the food and energy, the core CPI was the one that caught people's attention, being only 0.2%. And, after 4 months of staying at this 3.3 year core CPI year over year, we finally dropped it down to 3.2%. This might be that point where, we're done going flat and now we're curving to the downside. That's what it feels like. That's what it looks like. If you remember, when inflation was going up and everyone was saying, oh, it's just transitory and it's just transitory. We had gone up, we went sideways, and the Fed said, we want to see it tick higher before, we start restricting things because, we don't want rates to be at zero and go below zero. They said that explicitly. Not a lot of people talk about that. They wanted flat and then curving up to higher, and then they were chasing it higher, raising rates behind inflation. And it ran away. It was very high, and then it came down. It settled at that 3, and now we're at that point where it's actually starting to tick down. And this is the point when the Fed gets behind on the cutting side of it. A few of the main points to really very importantly understand is that when we have enormous amounts of fiscal deficits, hiking doesn't slow down inflation as much as people might normally expect, and we're on the other side of that now. We're at the other side of the curve. Now we're cutting. People are thinking 125 basis point cut is suddenly going to send inflation and jobs to the moon. It's not how it works. The cuts are referenced as often taking as much as a year to see the effects of the cuts happening. And so it's like a ship. It's like you turn it a little bit, you have to wait. A really big cruise ship, you turn, it doesn't start turning maybe even for like an hour. I don't know the exact thing, but the point is it takes a long time for the economy to shift and get accustomed to the new rates. And but we're at that point. CPI is not going back up higher. This core number dropping, it is significant. It is very significant, and markets reacted that way, at least today. And my whole thing on it is, it's good news. Inflation is going down until it's bad news when it turns into deflation, and things are falling apart, which is what I'm fully expecting here. No changes in the daily reminders. These are massively important items to have in the back of any serious investor's mind. I walk through all of these every once in a while. My most previous one was the macro update 11025 with dominoes in the crystal ball. I'm going to add one thing today. I'm going to say CPI cooling. This adds to the case that the economy that's where we are. It's a business cycle. It's not that hard to really see in the crystal ball where we go from here. With inflation going down, once something goes a certain direction, it usually keeps going in that direction. And in this case, this type of thing can accelerate and get out of control actually pretty quickly. That's when we get all, and it always surprises everybody. Like all of a sudden we have to have all these emergency cuts and all of that. It's all coming. It's all coming, and I think it's coming a lot sooner than other people think. With a 3 or 10 month, no, 3 month, 10 year normalizing. Very recently, December 13th, Friday the 13th. It's like, that's where we are. With that, there are no crystal ball reading changes. I'm still going to say that the bear market is developing. I'm not going to change that. It looks like, markets, I don't know if we'll go a little bit higher here. I might even just take this out, because today's movement upwards could mean that we go sideways or even go higher from here before things really fall apart. I'm not entirely sure, so I'm just going to get rid of that part of it. But the rest of the readings remain the same, and no changes in my portfolio, no major changes. Again, watch my macro show to hear me walk through all of this. Obviously, the most important chart of the day is the 10-year Treasury note yield. As I said in the beginning of the show, the best way I would describe it is that we are having fear of stagflation and further inflation subsiding. So longer rates are allowed to cool off a little bit here, and that's exactly what we got. And with borrowing rates going down a little bit, stocks obviously got a bid here. We'll get there when we get there. But yeah, 10-year note yield dropping almost 3%. Yeah. If we were to get initial jobless claims, and a bunch of other data comes out tomorrow, I'm only going to bring it up if it turns out to be very interesting. Although I'll probably bring up the initial jobless claims no matter what. I usually like to do that on a weekly basis. If that comes out, with jobless claims like increasing, like going crazy, then yields will continue dropping, but then stocks will also drop in that case. But if it's muted or even like lower, like way lower than normal, it's hard to say where rates will go from here, but I suspect, so I'm neutral on where rates will go in the immediate short term. Again, today's report, the worry of stagflation, inflation subsiding. Obviously, the 10-year break-even inflation rate is reacting to that, curling back down. I didn't bring this up, but on Monday we had gone up to a new peak of 2.45. So just, again, very important market to keep an eye on. The S&P 500, SPX, had a pretty good gap up today, breaking this pattern. We had head and shoulders top, we tested the line, and of course, so today, again, it just gave the market enough release to just jump right back over that line. The newer pattern here is obviously, we have a bit of a parallel channel here developing that looks like we might stay in, which is, it's a bearish channel. It's going to take a little bit of work to get above this line. Be very interesting to see what happens from here. The overall feeling I'm getting from the way markets have been moving lately is the markets are getting very sensitive to news. Like one little, think about it. The core inflation, being 0.1% less than what the market expects, and we're able to go up 1.8% in the S&P 500, and the 10-year note dropping here. Like there's not a lot of let's say stability going on. It's like crazy people are Mr. Market. If you've been watching the show, I describe Mr. Market as this crazy person, and it's like right now there's like somebody just like pulling on the wheel, someone else in the car. That's kind of what it feels like right now. But so they're getting a little wild here is the best way I describe it. TLT, still my favorite place to be, rising just as much as the S&P 500 today, going up by 1.7%. I talked about this yesterday, being in a range where it's obvious to me that people that are selling treasury bonds, the majority of them are selling them at a loss, which means they're selling them because they have to, not because they want to. And so it's going to give the sellers a little bit of like, oh, thank goodness we can get out at a little bit higher of a price. And for me, it's like, yeah, I'm glad to be having 58% of my entire portfolio in this. And yeah, I, you know, I'm not sure I want to go much higher than 58% because of the fact that I will always have in the back of my head the very good advice, which is that, assume that you're wrong. If I'm wrong, am I going to be okay? You know, if you don't think that way, what you can end up doing is going 100% into TMF, and then let's say you're wrong and, you go down by 30, 40%. That's not going to feel good, if you're wrong. But, you have the right balance of things. I love my portfolio. I think it's the most rational choices that I could possibly make. But yeah, we'll see how it plays out. With the 10-year note yield dropping pretty good today, it's interesting that the Fed funds futures has not changed. We're still looking at no cut until June of 2025. I mean, the chance of a May cut rose, by 6%, a little bit here. So it wouldn't surprise me if we go further in that direction, again, sooner than people think. This is what I'm seeing with my crystal ball. With headlines saying, "Oh my goodness, the stocks are on fire, they're going to the moon again." Fear and greed index seen in business is still near extreme fear. I find that to be pretty interesting. So I'm very curious to see if this rally in stocks specifically has some legs to it, if there's going to be enough buyers in here to send things higher, or if this is going to function as a 1 day, thank goodness there's more exit liquidity kind of day. Well, we'll see. I mentioned yesterday verified investing. Gareth Solway, one of my favorite traders to follow. His show is amazing on YouTube. He's got a website and everything. I'm wondering if he got stopped out of his short today. He's been I think he started shorting at 74 and has been shorting in this area. Wow, $80.50. This might be why he didn't do his trading the close show today and had two of his traders doing it instead. I don't know. I'm kind of curious about what he's doing, but oil does. I said yesterday, myself on this show, it looks like it's going up, and typically when things go up, they just keep going up until they stop going up, and oil went up. What else can you say? With the 10-year yield dropping, typically, again, rates follow oil. So 1 day is not much, but it is interesting. Oil shooting up the same day as, the 10-year collapsing a little bit. Bitcoin I wanted to bring up because, along with money going into other, risk assets, and which I'm defining right now as including stocks. If you connect the all-time high to January 7th high, we kissed that trend line exactly today. So yeah, my feeling on this is we'll probably stay within this wedge until we break out. There is a possibility of breaking out to the upside here. This is why I'm happy to have. I lost money on getting out of a short. If you're following the show, I shorted. I think it was January 9th, because it looked like we were breaking that line there, and then I got out. Is this a daily chart? I don't remember. No, maybe it was December 30th. I don't know. I shorted and I got out. I thought we were breaking this like head and shoulders neckline, and we didn't. We're still in here, and it's not. I don't know where it's going to go from here. My question here too is, can Bitcoin decouple from other risk assets like the stock market? I mean, certainly there are a lot of voices out there, especially, yes, we can keep printing infinite amounts of dollars, and we can't keep printing infinite amounts of Bitcoin. So there's a natural deflationary aspect to Bitcoin, which can send it higher, especially if there's fear of more money printing. But at the same time, when all assets get stressed and people run out of money to put into risk assets such as Bitcoin, which I consider to be an extreme risk assets, it can make the price go down. I don't know if it's going to go up or down. As far as Mr. Market goes, this is Mr. Market's, crazy cousin who's just a whole nother animal. He's not even on Earth. He's flying through space in his car, and he doesn't understand how he got there. Last chart of the day, just because we're at all-time lows again in the cannabis industry, this is MSOS. This is index fund of cannabis stocks in the U.S. Yeah, getting down to $3.43. Yeah, I mean, is every company in this industry going to go, disappear because of regulation and fear of investment? Really, everybody going to run away from this? Yeah, maybe. Or the fear is overdone, and the new administrations in power are not actually as against it as most people might fear or imagine. But I don't know. I think this may be a great opportunity. If you're following the show, I have about 1% of my own portfolio in this fund, and I'm excited about it any which way. Even if it goes to zero, it's still exciting. But anyway, that's all from me and my crystal ball. I hope you enjoyed, and see you next time. Robschild.